Kalshi and Polymarket look like betting platforms, but structurally, they behave more like financial markets. And the reason they've exploded in popularity has very little to do with gambling. Welcome to Xplementary. This video focuses on the US, as most of the activity is driven by US users and US-centric events. Chapter 1. Setting the scene. To understand prediction markets, you have to go back to how gambling was structured in the US. For decades, sports betting was effectively banned nationwide under the PASPA, the Professional and Amateur Sports Protection Act of 1992. Outside of a few states, most notably Nevada, it simply did not exist. That changed in 2018, with the Murphy v. NCAA decision, where the Supreme Court ruled PASPA unconstitutional. This did not legalize sports betting outright, but it gave individual states the power to decide for themselves. The impact was immediate. Within a few years, more than 30 states had legalized sports betting in some form. The total annual handle went from effectively zero outside Nevada to well over $100 billion. Companies like DraftKings and FanDuel scaled rapidly by making betting accessible through mobile apps, integrated payments, promotions, and live odds into a single interface. This was the key shift. Gambling moved from something physical and occasional to something digital, constant, and frictionless. At the same time, a parallel financial system was emerging through crypto. The rise of Bitcoin and Ethereum introduced a way to move money globally without relying on banks or payment processors. More importantly, crypto removed the financial gatekeepers. You no longer need a bank, a bookmaker, or even a company to sit in the middle of transactions. You just need code. Money goes in, money comes out. No approvals, no restrictions, and no one asking where you are from. Once these two trends converged, the underlying logic expanded. If people are comfortable betting on sports outcomes, and there exists a global permissionless financial system, there is no real barrier to betting on any uncertain event. The idea is not entirely new. Academic prediction markets have existed for decades, and platforms like the Iowa electronic market were already being used to forecast elections as early as the 1980s. What changed after 2018 was not the concept, it was the scale, the accessibility, and the infrastructure supporting it. Chapter 2. Prediction Markets. This is where things get interesting, because this is where Kalshi and Polymarket enter. Kalshi was founded in 2018, the same year PASPA was overturned, and took a regulatory-first approach. It became the first federally regulated exchange for event contracts in the US. Its products are structured as binary contracts with clear settlement conditions, covering areas like inflation releases, unemployment rates, and political control of Congress. Kalshi operates within the traditional financial system. That gives it legitimacy, but also limits what it can offer. Polymarket, founded in 2020, took a completely different route. Built on blockchain infrastructure, it allows users globally to trade on event outcomes using crypto. Users can connect a wallet, fund it with stablecoins, and immediately start trading. Polymarket does the exact opposite to Kalshi. It removes constraints, goes global, and scales faster, with some markets reaching tens of millions of dollars in volume quickly. But despite the growth, both platforms still operate in a heavily restricted environment. Polymarket is currently blocked in over 30 countries, while Kalshi is restricted across more than 50 jurisdictions. Even within the US, at least 11 states have taken legal action against prediction markets, issuing cease and desist orders or considering new legislation. At the same time, demand clearly has not slowed. Both platforms are reportedly exploring new funding rounds that could value them at around $20 billion. Both platforms also operate very differently from traditional gambling operators. They are not the house taking on the risk. They are marketplaces. Users trade against each other, taking opposite sides of the same contract. The platform simply facilitates the transaction. In other words, you are not betting against the platform. You are betting against someone else. This means their revenue model is closer to an exchange than a casino. On Kalshi, users are charged a transaction fee when trades are matched. The fee is small and depends on both the price of the contract and the number of contracts traded. But in practice, it usually works out to well under 1% for most users. There are also additional fees depending on how you deposit or withdraw funds. For example, around 2% for card deposits, whilst bank transfers can be free. Polymarket takes a different approach. For a long time, it operated close to zero fees, but it has since introduced a dynamic fee model. Traders who immediately execute against existing orders, known as takers, can pay fees of up to 1 to 2% depending on the market. Those who provide liquidity, known as makers, can often pay nothing and can even receive rebates funded by those fees. The key point is that both platforms are designed to maximize trading activity. The more volume that flows through the market, the more they earn. They do not need users to lose, they just need users to keep trading. The platform does not care who wins the bet, it just cares that the bet happens. In essence, prediction markets today are the product of two forces: the normalization of gambling through legalization of mobile platforms, and the emergence of crypto as a global, permissionless financial layer. One made the behavior mainstream, the other made it scalable. Chapter 3: Gen Z, the doomed generation. It probably is not surprising why these platforms have gained so much popularity. Gambling is inherently addictive, and real life have become even more dramatic than any sports league. Unfortunately, gambling, and what the internet lovingly refers to as degen behavior, have become even more normalized as a result. However, this behavior did not start with prediction markets. You could argue it started in 2012, when the term YOLO was popularized by Drake through his encouragement of living life to the fullest. He probably didn't mean betting, but nevertheless it showed up on Wall Street Bets on Reddit, where speculation became entertainment. It eventually developed into meme stocks like GameStop and AMC in 2021, where retail investors, stuck at home with stimulus checks, coordinated to push prices in highly shorted names. From there, participation shifted into even more leveraged instruments like zero-day options, where contracts expire within 24 hours and offer extremely convex payoffs. Prediction markets are simply the next step. They remove even the need to interpret asset prices and allow direct bets on outcomes. The macro backdrop matters here. Gen Z went through COVID during their university years, which disrupted education and early career entry. Now they are entering a labor market where layoffs are increasingly common and tied to AI adoption. At the same time, asset prices have moved significantly out of reach. In the US, top 10% of household accounts for more than 50% of total consumer spending, and housing affordability has deteriorated to levels where the median home price to income ratio is at historic highs. So what options are actually left? For many, traditional paths like saving and incremental investing feels too slow relative to the gap they are trying to close. That pushes behavior towards asymmetrical payoffs. In finance, that means positions where downside is capped, but upside is multiple times the initial stake. Venture capital operates on this logic. Most investments fail, but a few outsized winners generate all the returns. The difference is that here, individuals are applying that same logic to their own capital. They are gambling with their own future. Chapter 4: Insider Trading. Young people entering these markets are facing an increasingly uneven playing field, which brings us to insider trading. In traditional financial markets, insider trading is illegal, monitored, and whilst not eliminated, at least constrained by regulation and surveillance. Trades can be linked to accounts, and there are clear definitions around material non-public information. Prediction markets complicate this. You are no longer trading a company's financial or securities. You are trading outcomes tied to events, policies, or decisions. Accounts like Unusual Whales have shown that unusual trading activity can often precede major announcements in equities and derivative markets. Patterns have been observed for years, such as oil futures moving ahead of geopolitical developments. For example, over $800 million was traded in oil futures just minutes before Donald Trump announced negotiations with Iran. If someone has early access to information about a political decision, an election development, or a macro event, they do not need to analyze multiple variables. They can simply take a position on the result. They do not need to interpret the market, they just bet on the outcome. This reduces the gap between information and profit. It also makes manipulation more feasible, as concentrated capital can move probabilities in relatively thin markets, influencing perception as well as price. There is also a structural issue here. Despite platforms framing themselves as exchanges, participants can still treat these positions as bets rather than trades. That ambiguity makes it easy to justify acting on information that would be considered insider trading in traditional markets. At the same time, platforms are not strongly incentivized to stop this behavior. Their revenue is driven by volume, not outcomes. The more people trade, the more they earn, regardless of where the information comes from. So where does that leave us? And what is the point of all of this? The initial goal was to give context on the rise of prediction markets, but it is difficult to separate them from the broader environment which they exist in. Prediction markets combine elements of finance, gambling, and technology. On paper, they can improve forecasting by aggregating dispersed information into a single price. In practice, they also reflect a shifting behaviour. When a generation faces slower income growth, higher asset prices, and more uncertainty, participation shifts towards higher risk and higher variance strategies. Maybe prediction markets do have a role on improving how we understand probabilities, but their growth is also a signal. It shows that more people are engaging in speculative behaviour, not necessarily because they want to, but because the alternative feels insufficient. If prediction markets are the future, what does that say about the world we are trying to predict? Have you placed bets on current events? How do you feel about the ethical dilemma of these bets? Share your story in the comments below, and don't forget to subscribe for more deep dives into the economics and tech shaping our world.